Okay, welcome to my presentation, Volume Profile and Order Flow Analysis. My name is Michael Valtos. I'm the founder and trader at Orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so what's volume profile and order flow analysis? Well, when you think of the market, the market is a big puzzle, and ideally you want to put all the pieces together and have the puzzle solved, just like the Rubik's Cube. You want to solve it and have all the colors on the right side. In the best world, yes, you're going to have it solved, but the reality is you're not. And no one could figure out the market 100%. Nobody claims to. However, what you can get, you could find that areas in the market where opportunities are being presented to you on a daily basis, and you can get close to having it solved, close to having the puzzle solved, at least having a side solved on the Rubik's Cube, and you can make better trading decisions. Volume profile is a tool. It's not a trading system. Just like order flow is a tool, it's not a trading system. And you're going to use them together to find better trading opportunities, to make better trades, to make money. Basically, that's the whole point. People come to the markets to trade, is they want to make money. People don't come to the markets to exercise their brain. They come to the markets to make money, and that's just that's why they're there. And people say, yeah, you're hedging, you're laying off risk. Well, yeah, but the bottom line is the reason you're doing that is to make money. Now, there's all sorts of different types of traders, but that's another topic altogether. What we're going to talk about today is the volume profile, and to a lesser extent, order flow. But ideally, what you want to do is you want to put volume profile and order flow analysis together. So, beginning traders, traders that are new to the market sometimes think that to become successful, they have to have a complete, comprehensive understanding of how the market works under all conditions. That's not true. There's so many different conditions, and conditions change all the time. Sometimes, things that affected the market 100 years ago don't affect it today. What you need is a general understanding of the markets. And, sometimes that's not even, I'll say that's not enough, but, nowadays, there's so much hedge fund money in the markets that it's causing markets to move, beyond their standard deviations. Normally, a market will have, 1 or 2 standard deviation move a day, but, sometimes with all the money that's coming from the hedge funds, you're getting moves extended, 3 standard deviations, 4 standard deviations, just because, when the hedge funds all of a sudden all say, hey, let's, risk off and dump all their positions, they're not necessarily concerned about price. They just want to get out. And it's causing, extra moves in the market that, 30 years ago, 10 years ago even, weren't there. And, so that's where volume profile comes into play, is because, most people already have knowledge on volume profile, and they don't even realize it. When you think of volume profile, you think of volume, but really what volume profile helps you to determine is value. When you think of things in terms of value, it really puts the market more into perspective. So, what I really want to stress to you is you have to start thinking in terms of value. What something is worth now and what something will be worth in the future. People have to consume commodities, right? And so, if you want to buy something, is it better to buy it cheaper now, knowing that you're going to use it down the line? Well, yeah. Especially if, your needs today may be, like, okay, perfect example, paper towels, right? You know, you go through a roll a week, and normally you pay $1 for a roll of paper towels. Well, you go to the store and they have it on sale for 50 cents, you know, half off. So all of a sudden now you can buy twice as much. You know, your consumption is still going to be there, but you know, over the next month you're still going to use 4. So you know, you could buy 4 for $2 now, when yesterday you could only buy, you know, 4 for $4. So you know you're going to have that consumption, and so you know, you're going to be more inclined to buy more now at a cheaper price, knowing that you're going to be able to use it in the future. You know, or conversely, say, you know, you have your own little 7-Eleven shop, and you go into the grocery store and you see, hey, I could buy paper towels here for 50 cents, and I know I can sell it in my store. You know, people come to the store at midnight when the regular grocery store is closed, looking for paper towels, and I could sell it for $1.50. So while you're thinking, hey, I could buy it for 50 cents and sell it in my store for $1.50, yeah, you'll buy it all day long. You know, you buy it at 50 cents and try to sell it at $1.50 all day long. Okay, so you know, the value area, you know, when we talk about value area, they talk about it on a daily basis generally, and the value area is where 70% of the day's trades occur. And you know, what is value? Okay, that's a, you know, everyone says, well, how do you determine value? You know, okay, well, it's obviously where most of the trades occur, but it's the price level where traders bid and offer back and forth until the price is agreed on and trade facilitated. And the area, you know, where you have the most trades facilitated is the value area. I mean, there's going to be trades, you know, up and down all day long. You know, the market's going to move up and down, but it's the area where majority of the trade is facilitated. That's your value area. And once you know where value is, you will know that, you know, when the market moves away from value to an unfair price level. And why is that important? Is because the market moves away. You know, it goes from value to unfair prices and then back to value. You know, you could be looking for a new value area. You could be probing, just, you know, checking prices out if, you know, if the market's got the capacity to move higher, if prices are going to be accepted at a new level. You know, that's what the market does. You know, it's there to, you know, advertise price. So, you know, why should you consider volume profile? Well, volume profile is simple in concept, but a little bit more complex in detail. In simple terms, volume profile shows support and resistance. You can see quickly if price is moving up or down or sideways. You know, if price is moving sideways, you know, we've reached a level where price is accepted, trade is facilitated very easily without, you know, much fluctuation. And ideally, I mean, that's the purpose of the market, is to facilitate trade. It's there to transfer risk from one party to another. If price is moving up or down, you know, it hasn't found its value yet. You know, it hasn't found its value area yet. You know, it's looking for that area where majority of trade, you know, majority of traders are happy to conduct trade. So what's the logic behind volume profile? Well, volume profile measures how effectively the market is distributing. When I say distributing, it's distributing inventory. You know, it's transferring inventory from one party to another, from buyers to sellers, and from sellers to buyers. Now, what's important to remember is volume profile is not a trading system. It's a tool that should be used to support a trading decision, and should be used in conjunction with order flow or other technical analysis. Me personally, I prefer order flow because it's really giving you an indication as to who is really in control of the market. Now, what I find is the real beauty of volume profiles is based on raw data that's not manipulated with any mathematical formula and truly reflects the reality of the market. You're dealing with what's happening as opposed to what might happen. The market bias is easy to see and apply when you're looking at volume profile and you're using it with order flow. You know, I mean, that's why I really, I'll say love, but, you know, really appreciate volume profile and order flows, because it's the data that's generated by the market. You're not taking a price and, you know, averaging it out over a certain time period and doing some big mathematical formulation, some calculations to manipulate that price into something else. You're not. You're looking at, where prices are trading. You're looking at the volume that's being traded, and you're seeing who's buying and who's selling. You're seeing if prices are being rejected or not. I often say, order flow is a thinking man's way to look at the market, and it is, because you got to make these decisions. You're seeing things develop in the order flow, you're seeing things develop in the volume profile, and you have to make trading decisions based off of what you're seeing. So, what is volume profile? It's a vertical bell curve that captures the developing market dynamics of volume at a price over time and organizes it in a way to show the trader where buyers and sellers are interacting within the market. More importantly, volume profile will help you identify price levels that are acceptable and unacceptable to buyers and sellers, especially when it's used along with order flow. So how does it look? It's right here on the side here. This is a screenshot. You can't see if, when you have the Orderflows Trader software, there's a button up here that says display. You can click on that, and there's one that says volume profile. You can enable it, and you'll get this. And, just real quick, a quick explanation of it. This is the vertical bell curve, and it's capturing the volume traded at this price. So you can see, 1528 traded at 2055.50, 7585 traded at 2055 and a quarter, 11,340 traded at 2055, and so on. And you'll see two different colors here. The green color is what was traded on the bid. The red color is what was traded on the offer. Generally, it's going to be pretty evenly mixed. Now, this is an order flow footprint chart. This is just a chart from the other day, Friday. We came up here, tested these levels, and then market sold off. Okay, by understanding what's going on in the order flow as well as the volume profile, you can take these trades. This was a small trade. Sold it at 53, bought it back at 51. Here's one I sold it at 53 and a quarter. I bought it back at 48 and a quarter. When you're putting it all together, it really makes the market easier. Easier to read. I'll say easier. But you can understand what's happening in the market and take better trading opportunities. So conventional charting analysis is generally derived from looking at individual price points. Volume profile analysis takes the market's entire activity to give you an impression of what's happening in the market. Again, this is a macro picture of what's happening during the trading day. When you're just trading, with a simple indicator, you're just looking at the last traded price and, and however it's based off of that. Volume profile shows you where value, or the fair price, is forming in the market and gives you the opportunity to take advantage of opportunities when the market moves from value to unfair prices, where they can either be rejected or accepted. Again, your value area is going to be the big portions, the portions that really stick out. And when you move outside of those areas, you're going to want to see, is price being rejected or is price being accepted? If price is going to be accepted, you're going to start to put in a lot more volume at those areas. If price is being rejected, price will move away from those areas. So knowing when the market is in an unfair price level, you can take advantage of it, because the market will often trade back to the established value area or search out a new value area. This is where understanding the order flow will help you. And by interpreting the order flow, you can determine if the market internals are showing signs of strength or weakness when the market has reached the unfair price. Okay, so this is a bond from Friday. And, we had put in this value area most of the morning, and we're rallying up, start rallying late in the session. This is going in around lunchtime, and in order flows, we get up to this level, and you want to know it, when you're getting up to the highs, is price going to be accepted or rejected? You want to see something in the order flow, and, you can see the volume profile is, is it being accepted, or does it have a chance to be accepted or rejected? And what happens, we get them up to this high, and we start to come off a little bit. You have this big area in here. This is around the 24, 25, 26 level, and right now, we're trading at 164.16. This is 163.24. If we're going to sell off, we may have a chance to come back down at least to half back, or if not back, all the way down to this value area. So it's going to give you an opportunity for a decent trade. So, it's important to remember why the market exists. It exists to facilitate trade. The market will probe higher to prices to attract sellers and lower to prices to attract buyers. What that means is, the market will move up. People will be buying it till it reaches a level where, a lot of people come out of the woodworks or wherever and, are willing to sell. And oftentimes then the market will move back down. Now people, sellers will come in, they'll move the market lower, 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 and finally people will realize, hey, this is cheap, this is a good deal. They'll buy it and they'll move it back up. An imbalance of buyers drive prices higher until sellers are attracted to the higher prices and enter the market and trade move prices lower. That's just what I explained. The imbalance of sellers drive prices lower until buyers become attracted to the lower prices and they come back. So, this is what the rotation process the market goes through in searching for a fair price in the market. So you're going to have, that's why you see, markets generally are not stagnant. It doesn't normally just trade at one price. The market moves up, it moves down. It moves to levels where there are going to be more buyers, or there's going to be more sellers. And in order to get there, people have to trade. And when people trade, that's what starts to move the market. Now, markets have two types of movements, basically. There's vertically and horizontally. Generally, though, it's a blend of both movement, and it doesn't take into account time. When you say vertically and horizontally, you're not looking at, how vertical it went over, 1 minute, or horizontal it went over 2 minutes. Markets that move horizontally spend a lot of time around the same price. Generally, the market is balanced. It's consolidation. The market is developing. Markets that move vertically, up and down, spend little time at or around a price. The market is imbalanced, is trending. The market is distributing. Also, the market is looking for, a balanced area. It's looking for a level where trade can be facilitated with everybody being satisfied and not moving. That's when the market's going to start moving horizontally. Okay, so here's a case. This is E-minis. Earlier in the day we were moving horizontally here. We're putting in a distribution. You can see it getting fatter out here, and then the market moved up. It probed. It started looking for another area. If prices were going to be accepted or rejected a little bit higher than this previous value area. And what happened? We found a new value area where the market started moving horizontally. That's what markets do. They move vertically, they move horizontally. It's often, a mix. You can't have it. You can't move vertically and horizontally at the same time, but you'll move horizontally, then you'll move vertically, then you'll move horizontally again, then you'll move vertically again. Okay, so when a market is imbalanced, it signals that there's a large shift in capital, and it's either going into or out of the market, which causes prices to move quickly. Now, when you say a market is imbalanced, it means there's, either, buyers are in control or sellers are in control. You're never going to have more buyers than sellers, but what you're going to have is you're going to have more aggressive buyers, you're going to have more aggressive sellers. And when a market is imbalanced, that's where the big trading opportunities are going to be found. And the market's always moving from an unfair price area to a fair price area, and then again to an unfair price. Now, it's not going to do it very quickly sometimes. Sometimes it may take all day. It may take 15 minutes. It really depends. But, that's what, the markets move. And they move from unfair prices to fair prices. Then when trading is satisfied, it's going to look for another price level. When a market is balanced, it starts trading horizontally, meaning prices trading in a tighter range as the market facilitates trade at a fair price level. The market is accepting these prices. Again, when a market is moving horizontally, it's putting in, it's putting in the value. People are happy to trade at those prices. The market is accepting those prices. Everyone is happy to trade as much volume as they can at those levels before it starts to move away, because they know that hey, we're putting in a new value area here. This is the perceived value for right now. They want to start, they got to start trading it, because knowing that the market is not going to stay at a price level for an extended period of time. I mean, it may stay there for a day or two. But it's not going to stay there for a month, and it's going to move either higher or lower. So if your perception of value is here right now, you're going to want to trade as much as you can. So accepted prices show value. Their price levels, accepted price levels over time become the value area, and most of the day's volume occurs in the value area. So volume profile provides a view of how the market is trading. You can see quickly what prices are being accepted by the market and what prices are being rejected by the market. As the volume profile develops throughout the trading day, certain volume profile shapes or structures develop. Now there's basically five main ones, and then there's a few offshoots, which I'll talk about later. But you have the non-trend day, the normal variation day, the trend day, and the neutral day. Okay, so again, like I said, there's a couple other offshoots that it's not on this list, but it's in this presentation. After I get through these 5 days, I'll talk about the other couple of days. So as the trading day progresses and the volume profile develops, the shape or structure will give you, the trader, clues as to the buyers and sellers' behaviors for the day. So you can see, as the day develops, it's going to change. The volume profile is going to change. You're going to see, at certain times of the day, you can have a value area at a certain level, but as you start to trade, you're going to put in more volume, and you're going to get you may get a different value area. The value area may change. It may go higher. It may go lower. It may stay the same and just expand. It really, really depends on how the day progresses. So a non-trend day is characterized by a narrow range with no or almost no extension of prices beyond the early volume profile. Long-term traders are not present in the market. Market participants are not really reacting to higher or lower prices since the day's range is narrow. So while a normal day is boring, you often get moves in the following days, so be prepared. So I'll give you a quick example. Non-trend day, it's a day where you have this profile. It's just like this. Your value area is pretty much in the middle. Yeah, you have a little bit of movement up, you have a little bit of movement down, but you're spending most of the time around here, and you have a very narrow trading range. Okay, this is what it looked like on a normal bar chart. So anticipate big moves in the days following the non-trend day. And you can see this is the S&P. It's a daily chart, and basically we went up. This price was, I don't know what that was, 29.80, but then the next day you had this big move basically from 29.50 all the way up to almost 3,000, and then in the subsequent days you rallied almost another 100 points. Okay, the next type of day is a normal day, and it's characterized by brief price probes to the high of the range, which is met with selling, which often results in some consolidation, as well as price probes to the lows, which are met with buying, and sometimes also results in consolidation. The majority of trades occur within a value area where most of the trade for the day is conducted. You have very little imbalances occurring generally on a normal day. In a normal day, it looks a bit like the previous day that I showed you, the non-trend day, but you have a bigger range. You get probes to the high, probes to the low. Sometimes you might put a little bit of value down towards the low, or a bit of value up towards the high. But in general, it's a range day that's a little bit wider than I think than just your normal non-trend day. Your normal non-trend day is usually the days you get ahead of the Fed, or the non-farm payroll number, or even in the grains, it's something that you're going to get ahead of the USDA's supply and demand report. But on a normal day, as I said, you're going to have generally a bigger range, and you're going to get rotations lower, rotations higher. You're going to maybe spend a little bit of time up near the high, a little bit of time near the low. Sort of work your way back towards the value area and do a lot of trading in there. The normal variation day is characterized by having range extensions where traders extend the price range beyond the existing early value area. So when the market moves higher above the value area, instead of tracking sufficient selling to move prices back to the value area or consolidation, what you have is additional buying coming in and to support the prices above the value area. And similarly, a range extension can occur below the value area when selling comes in and it's not met with sufficient buying to support the market. Longer term traders are present in the market, but they're not necessarily the majority. And how does it look? It looks a bit like this. You're seeing various value areas spread out during the day. The market's moving up, it's putting in value. It's moving down, it's putting in value. Move backs up, puts in value. Back and forth. It's not as a nice bell-shaped curve. You're not your normal distribution. Like a D shape. This day is a bit more ugly, but you're getting probes up, stopping, putting in volume, trading back and forth, coming down lower, or even going higher, trading, putting in more volume, putting in another value area, putting in areas in there, at different price levels. Now, a trend day, trend days are days where, you'd love to buy it. Everybody would love to buy on the open on a trend day and sell on the close. But it's characterized by a dramatic move from the value area, and the market moves consistently in one direction while not spending too much time in a price area that is going to attract buyers or sellers to result in a significant value area through the extended consolidation at a price area, just as we saw earlier on the previous chart, the normal variation. You saw you were moving up, putting in value area, moving up, putting in value area. Trend day is a bit thinner. You don't have those extra value areas. So a trend day generally holds its direction with successive highs, higher highs, and higher lows. Or if it's a move down, it's going to do lower lows and lower highs throughout the day. Long-term traders are the majority of traders on days. They have trend days, and they will often close near the high or the low. When I talk about long-term traders, you have to keep in mind who are the people that are going to move the markets, and it's going to be the long-term traders. Whether you could say the institutions, the commercials, the real money, the people that have a long-term view. And why is that important? It's because they view value at a certain area today, and they have a view of where value should be in the future. It's not going to be the short-term traders, the intraday traders that are necessarily moving the market on a trend day. It's the long-term traders, the people with the deep pockets that are going to be moving the market in generally. Those are the people that move the markets 90% of the time on a daily basis. So when you have a trend day, you can see long-term traders are coming into the markets and they're participating. And what you want to be able to do is you want to be able to determine, is today going to be a trend day? Are the majority, are the long-term traders present? And how does the profile look? Okay, well, this is a 10-year chart. 10 years are very thick, deep, liquid markets. And you're getting these areas. Here, this yellow line is the opening price, and you can see we're just sort of trend, going lower, going lower, going lower. Not really putting in. This is where we opened. This yellow line here. So we opened up here. 131.01. And we're just trading down all day. Then we're coming down towards, we have this area in here. We got the big volume, the big value area, and we just basically spend, the rest of the day down in this area. So, the long-term traders came in and like, hey, we gotta, this price is too high for, it's a good sell. I'll say this price is too high. They can see we're trading up here. but their view is, we should be trading down here. So they're coming in and they're selling it. They're the ones moving the market down. And that's where it gets to this level, where you now have price acceptance. And you can see we just spent all day here. Basically, this is 9 in the morning until 4 o'clock in the afternoon. And so while we opened up here, we opened up and, I said the longer term traders came in and realized, hey, we shouldn't be trading at this level. And they're the ones that move the market down. I mean, there'll be short-term traders also participating, but, in general, it's going to take a lot of money to move this market, especially, this is the 10 years where you're getting, very, very strong volume, thousands and thousands on the bid and the offer. Now, the other type of day, the last type of the main days, is the neutral day, and it's characterized by both upside and downside range extensions, but the market ends up trading around unchanged for the day. And what's key to understanding a neutral day is that both long-term buyers and sellers are actively trading against each other. And normally range extension is caused by long-term traders, but on a neutral day, the long-term buyer is, basically runs into a long-term seller, and they're sort of, button heads, and, they're at that same level more or less. And, so when a range extension starts, there's often little or no follow through. Now, some of these days, honestly, they do look a bit similar. The normal day and a neutral day are, on a chart, can look very similar. And that's why I like to, use it with the order flows. And, for me, one of the main differences is on normal days, there are imbalances, but they tend to fail. I mean, by imbalance, I mean stacked imbalances. I mean, there's going to be imbalances here and there spread out, but, when you're getting things that normally should be, working imbalances, when they're failing, what the market's telling you is that, when you have a stacked imbalance, you're having, levels of aggressive buying, stacked on top of each other, but then, when it's met with selling, strong selling, the imbalance is going to fail. What you're seeing is, people, say it's a stacked buying imbalance, people coming in, rushing into the market because they think prices are going higher, but then, we tick up a little bit, of the big sellers come in and move the markets back down. Your imbalances are failing. So, a neutral day, it's sort of, it looks like this. I mean, it looks very similar to a normal day. But you're seeing, some buying and selling. Like earlier you saw some aggressive buying. You got a couple imbalances, and boom, you get a big selling imbalance. Here you got a buying imbalance, and literally at the same level you got a selling imbalance. Here you got some buying imbalances coming up, but then here you got 2,000. Which is a big number. But then where's the follow through? It's not there, and all of a sudden you see very heavy volume just on the other side. Some very good selling, 1,600, even on the upper side, 1,700 at the high, 785. We're just a little bit higher above, or 3 cents above the opening price. Just your value area sticks out, right here in the middle. So, a couple other type of days I want to talk about real quick. The double distribution trend day. So it's an offshoot of the trend day, and it's the double distribution trend day. And it's characterized by when prices move away from early value and forms a second value area for the day. And what it looks like is this is the E-minis. We had put in this value area down here. This is lower here at 2066, this area. And then later, things happened. The market popped up, and all of a sudden we're putting in another value area right up here, right above this. You have a very skinny area here, a low volume node, low volume area, and we sort of never came back down to fill it in. Instead, we're putting in another value area right up here. So, and the other type of day I want to talk about is the running profile day, and it's a combination of different day types. It's basically when a double distribution trend day is characterized by two value areas. A running profile day is characterized by when the market shifts from a normal day which is this distinct value area, then turns into a trend day. These days, it's a little bit harder to see sometimes. Again, it's you got your value area down in here. Earlier I remember this day. We're putting in this value area. Then, we started running. We sort of have a double distribution day forming. Early on. And then, we start trending. We're putting in another value area slightly higher, and again, we just keep going higher and higher, putting in higher value areas. You see the value area here. This one's bigger. This one's bigger. This one's bigger. You're putting in subsequent value areas higher. This is a trend day up, or sorry, a running profile day up. If it was going down, you'd have to flip that upside down. So, a lot of these profiles, they do look alike. And, it's, I wanted to show you examples of different profiles. So, at least you got a basic understanding. But, really you don't need to, understand, today is forming a running profile day, or today is, forming a double distribution trend day. You don't need yet. Most people they don't need to know which type of day is forming, because days will change. And what can look like a type of day forming early will change, or can change over the course of the day. So, how often do different shapes occur? Well, the important thing to remember. The important thing to remember is the normal variation day probably occurs the most. And, that's at least a third of your days are going to be your normal variation day. Your neutral day is probably second, followed by the non-trend day. Normal days and trend days occur about the same amount, about 10% of the time. Other days, there's probably a couple other days I left out. I just couldn't recall what they were, but those are the two main ones. But they occur, maybe about 5 to 10%. These are not numbers set in stone by any means. This is my own observation. So if you can determine the type of day that's forming, you can project the type of moves you should expect and find trading opportunities. So if you are expecting a normal day, if it's shaping up to be a normal day, you can trade that type of day. If you're expecting a neutral day, you can trade around that. If you're expecting a trend day, again, you can, based on the type of trends, or sorry, the type of day that's forming, you can use that in your analysis. All right, and just a perfect example, if when you're sort of forming a non-trend day, right? Okay, the day closes, you look at the chart, yeah, I had a non-trend day. I can think, I can anticipate a move in the future. It may not be tomorrow, maybe the next day, but you're going to anticipate, something down the line. Same for a normal day. Your normal day, trading around the opening price. If you get up towards the high, you're probably going to be looking to sell it. If you get near the low, you're going to be looking to buy it. On a normal variation day, yeah, you're going to get, different value areas. It depends how you want to trade it. If it's a trend day, if you see a trend day developing, go with the trend. At some point, the trend is going to stop, and when you can see, where is it going to stop? You don't know necessarily yet, but then you can see the value area forming. And, I said if it's a trend day, trend days move in one direction, right? So if you start to move a little bit higher above the value area, you probably look to get short. On a neutral day, when you see imbalances, if you think it's a neutral day, look for the opposing volume to come into the market. Although I do think, neutral day and then normal days are very similar. So, again, you move away from value and you're trading above value, look for the selling volume to come in. Conversely, if you're trading below value, look for the buying volume to come in. double distribution days, look for, when you break out of the value area, look for the areas of very thin volume. And, if we sort of come back and it looks like we're going to fill that in, but we don't, that could be a good buying opportunity for you. So, volume profile can tell you when not to trade. Sometimes knowing when not to trade is like having a good trade. When there's no edge in a trade, when the market is facilitating trade where both buyers or sellers are happy to transact, you don't want to be trading in that area. You want to be trading, when you're outside of the value area. You want to be trading, when the market goes imbalanced and it looks like it's about to move back into a balanced area. Ideally where you'd like to trade. The market's purpose is to facilitate trade. It's to find and maintain a fair price. No one wants to trade intentionally at prices they know is unfair. I mean, nobody wants to pay more for something than they have to. Like yourself. You don't want to buy, a Pepsi for $1 and then walk down the street and see you could have bought it for 50 cents. You'd be kind of upset. So nobody wants to trade at prices that are unfair, unless they think that down the line the prices, even though it's unfair now, they may think a week from now it's going to be fair. But that's sort of a discussion on long-term traders. A market going nowhere, it's a market that's trading or in the value area. So even though you're getting signals, a ratio here, a ratio here, a ratio here, a ratio here, it's not reacting. You see, green candle, red candle, green candle, red candle, green candle, red. It's alternating up, down, up, down. And, you could tell by the volume profile, that's the value area. You're trading inside the value area, you're going to get the, there's just a little price rotations up and down. Now, high volume, let me just stress this, high volume represents value. It represents price acceptance. When market participants accept price, they continue to trade at that level. That's what horizontal price development is. Price is moving sideways over time. When market participants disagree on price, they quickly reject it. Sometimes it takes a little bit of time for them to reject it, but in general, it's rejected pretty quick. Vertical price development, that's what it is. Prices are being rejected. Prices are moving up and down and not sideways. Price that's moving up or down, over time is showing you, when a number comes out, right, an economic release comes out, you see price gyrate. It moves up, it moves down, it moves very quick. Price is being rejected at higher levels than it's being rejected at lower levels. It's searching for a fair price, a price that, people are going to start to trade again. And, oftentimes, after a number, it does take time for that to happen. So, another point that I want to stress to people is, no two trading opportunities are the same. There'll be times when some opportunities will be big and some will be small. This is where knowing the type of day you're in, as far as the volume profile, can tell you, if it's going to be a day with, smaller opportunities or bigger opportunities. So, smaller opportunities will happen when the market's balanced. Bigger opportunities will happen when the market's imbalanced. So, by looking at the volume profile, and seeing if you have a signal, an opportunity, but you're in the middle of the value area, well, what's your opportunity? Is it a big one or a small one? It's going to be a small one. Conversely, when you move away from the value, that's where you have the chance for a bigger opportunity. So when the market moves away from the value area, when it looks like it's breaking out, you want to know if the move will continue or revert back into the value area. And understanding the volume profile shape will help you determine this. Like we talked about earlier, there's different types of days. So if you get a trend day, you're going to be putting in, you're going to be moving away pretty quick, and then find your value area. On your double distribution day, that you move from one value area to another value area. And if you're not going to fill in, move back down into that other value area, that's where your next area for opportunities are going to be. So, knowing the type of day, or, well, I'll say knowing, but seeing the type of day as it develops will give you an opportunity to find bigger opportunities in the markets. So, talk about longer term money. If longer term money is doing the buying or selling as you move away from the value area, it's more serious, and the market has a higher probability of continuing in that direction. And why is that? It's because, think about it, right? It's when you think long-term trader, just as, say, your 401k is a long-term trade. You want to buy something now that, you're going to avail of in the future. So, the more confident the long-term trader is, the more likely he's going to move the market away from the value area because he thinks that the current value is cheap, or expensive, if he's selling it, to where he sees it in the future. Again, say, you see the price of, oil at $30, but for whatever reason, the long-term trader, he could be, it could be at a hedge fund, he could be at, an energy company, he could be working for, a sovereign wealth fund. It doesn't matter. The point is, he's a long-term trader. He's got a long-term view, and he's got long-term traders generally. When I say long-term traders, I'm talking about institutional traders. Okay, I'm not talking about, Joe from Idaho with, a $5,000 account. What I'm talking about is a long-term institutional trader. The commercial trader generally, or the real money trader. And, they think now the value of something is cheap. They're going to buy it, even if that means buying it above the current value area. So, like I said, if crude oil right now is trading around, $48. The value area is probably around let's call the value area $48. And, the long-term trader, the commercial trader that has needs, the refiner, they think, well, I can see what's developing in the market, and, the supply is getting smaller. I can buy it now for $48, and I know that I need to, refine a certain amount. I've got demand out there that, I'm struggling to meet. So, they'll buy it now when they can at this cheaper price because, their view is, maybe 2 weeks from now we're going to be trading, at $7 higher, $8 higher. So, that they're happy to buy it now, even if they think they're paying a little bit overs. They'll just buy it because they know, based on their needs, that, down the line it's going to be more expensive. That's why people think that, the big money, the institutional traders are in the know. They are because, they're using the product. They're not necessarily speculating. They have needs. They have real needs for most commodities. Now, one thing I want to talk about a little bit as well with volume profile is, when market profile and volume profile was first developed, you didn't necessarily have the overnight sessions. It was around slightly ahead of the time before Globex just started up, or when it was in its infancy. But so a lot of it was based on the markets opening and closing at a certain time. Now they're pretty much open 24 hours a day. So a question I often get is, when do you start your charts? Well, for me, you have to take into account the entire day. You can't disregard the overnight session. And it's going to change your volume profiles. It's going to change how they look because it measures the volume from the open. Now, you can adjust it in your settings on your software for when you want the day to start and things like that. But, if you're going back to, the evening, the open after the floor, I'll say the floor close, but basically the 5 p.m. open, you're going to have a lot more volume. About 30% of the volume for the day occurs from the reopen until the U.S. session main open, at 7 o'clock. So, keep that in mind. For me, I do look at that volume, and, especially on days where you get 10-point moves overnight from, high to low, it's going to mess up, I'll say mess up, but it's going to make your volume profile look a bit different. And, when you read a lot of stuff on market profile, volume profile, it really talks about the day session. But, for me, I really think you have to take into account the night session because it's there. Volume's traded, and it's legitimate volume. I mean, hedge funds do trade the night session. The real money traders do trade the night session. So, it's volume, it's there. You should analyze it as well. Okay, well, this one wasn't as long as I thought. About 50 minutes into this presentation, I thought it'd be a little bit longer, but, so if you want to know more about trading with order flow, visit my website, www.orderflows.com. I sell software. I have my own version of Orderflows software. I've written a book on trading with order flows. I have 15 hours of video instruction. I have a daily trading room. If you're interested in really learning order flow, how to tie it in with different ways of trading, and really how to understand what's happening in the market, order flows is the way to go. And if you want to avail my software package, get all this, get the software, my book, get access to my 15 hours of video instruction, join in the live trading room where you can see I'm in there for 2 hours a day in the morning, Monday through Friday. Once in a while I do take a day off. But, you can see me, I talk about the markets live. And, the days, the rooms are recorded. They're not posted online or anything like that. But, once you have access to the trading room, you can go into the archives and see them. They're more for, members of, membered people that have the software, that are serious about trading. I said if you seriously want to become a good trader, understanding order flow is really a key concept to trading. It's not, being a trader is not going out and buying a trading indicator, putting it on a trading system and letting it run. That's not being a trader. That's just being a trade follower. You don't understand what's happening, and as a result, then you're going to lose money. Then you're going to think, oh, the game is rigged and all that. It's not. People make a lot of money trading, and the reason they make a lot of money trading is because they understand what's happening in the markets. So thank you for watching this presentation. Again, visit my website to learn more. It's www.orderflows.com, or send me an email. I welcome your comments or suggestions. It may take me a day or two to get back to you, but I'll do my best to get back to you. So thanks, and I look forward to hearing from you.